Investing without analyzing a company's financial health is like setting sail without checking the weather. Sure, you might get lucky, but the odds are not in your favor. Understanding key financial metrics is crucial for any investor who wants to make informed decisions, reduce risks, and maximize returns. Financial analysis isn't just for Wall Street pros. It's a skill that anyone can learn with the right mindset and a bit of practice. One of the first places to start is with revenue, also known as the top line. Revenue represents the total amount of money a company brings in from its goods or services before any expenses are deducted. While revenue growth is important, it's equally critical to understand whether that growth is sustainable and how it translates to actual profits. Next, investors must focus on net income, commonly referred to as the bottom line. Net income is what's left after a company pays all its expenses, taxes, and interest. Positive net income shows that a company is profitable, but digging deeper reveals more insights. Comparing net income growth over time helps investors spot trends, and sudden drops or jumps can signal important changes in the business environment or management practices. Earnings per share, EPS, takes the net income and divides it by the number of outstanding shares. EPS shows how much profit a company generates per share of stock and is an important figure when comparing companies of different sizes. Investors often watch whether EPS is consistently growing year over year, which usually signals strong management and business performance. The price-to-earnings ratio, PE ratio, is another critical tool. This ratio compares a company's share price to its earnings per share. A high PE might indicate that a stock is overvalued, or it could reflect investors' expectations for high future growth. A low PE could suggest a stock is undervalued, or it might hint at underlying problems. The trick is to compare a company's PE to its historical averages, industry peers, and broader market benchmarks. Return on equity, ROE, is a measure of how efficiently a company uses shareholders' equity to generate profits. A high ROE indicates strong financial performance and efficient management. It's calculated by dividing net income by shareholder equity. ROE helps investors determine how well their money is being put to work and can highlight companies with sustainable competitive advantages. The debt-to-equity ratio shows how much debt a company uses to finance its assets relative to the value of shareholders' equity. High debt levels can increase a company's risk, especially during economic downturns when cash flow becomes strained. However, some industries, like utilities, naturally carry higher debt loads. Understanding industry norms is key to interpreting this metric correctly. Free cash flow is the money a company generates after accounting for cash outflows to support operations and maintain capital assets. Unlike net income, free cash flow is harder to manipulate through accounting tricks and provides a clearer picture of a company's ability to generate cash, pay dividends, reduce debt, and reinvest in growth opportunities. Gross margin and operating margin tell you how efficiently a company is producing and selling its products. Gross margin is revenue minus the cost of goods sold divided by revenue. It shows how much a company makes after covering direct production costs. Operating margin factors in additional operating expenses like salaries, rent, and marketing. Higher margins generally indicate better management efficiency and competitive advantages. Current ratio and quick ratio assess a company's short-term liquidity, the ability to pay off debts due within a year. The current ratio compares all current assets to current liabilities, while the quick ratio excludes inventory and other less liquid assets. Ratios above 1 are usually reassuring, but again, industry norms matter. Book value per share measures a company's net asset value divided by the number of outstanding shares. It provides a baseline valuation in case of liquidation and can help investors spot undervalued companies when the market price is below book value. Dividend yield is crucial for income-focused investors. It measures how much a company pays out in dividends relative to its stock price. A high dividend yield can be attractive, but if it's unusually high, it might signal underlying financial troubles or an unsustainably high payout. Understanding these financial metrics is only part of the equation. Smart investors always combine financial analysis with qualitative research, examining a company's leadership, competitive position, industry trends, and broader economic conditions. Numbers tell a story, but context brings it to life. The beauty of mastering financial analysis is that it empowers you to cut through hype, emotion, and market noise. Instead of chasing hot tips or reacting to market swings, you can make decisions based on data, logic, and long-term value. Financial literacy transforms investing from a gamble into a strategy. In the end, analyzing a company with the right financial metrics doesn't guarantee success, but it gives you a strong foundation to build wealth steadily and intelligently. The more you practice reading balance sheets, income statements, and cash flow reports, the sharper your investment instincts will become. Start small, stay consistent, and never stop learning. The market rewards patience, discipline, and informed decision-making.